Peggy Collins joins us now, personal finance reporter for Bloomberg News, with a look at what millionaires are doing with their money when it comes to investing in stocks. And who would have thought that they like ETFs very much, it seems. Peggy, welcome back.
Hi, Kathleen. Great to see you again.
So your latest story, tell us about millionaires. And this group in particular, this club is so interesting.
Yes, it's an exclusive investing network club called Tiger 21, and it's essentially a peer-to-peer group of people who have at least $10 million in investable assets. They pay about $30,000 a year in annual fees to be a member of the group. And what we got an exclusive look at their recent survey this year, which found that ETFs are growing in the preference by these millionaires as a way of investing in stocks, ahead of equity hedge funds and mutual funds. Still behind individual stock picking, but definitely surging ahead.
And your story talks a lot about the Spider S&P 500 ETF Trust, number 2 stock pick in an annual survey of the Tiger 21 Investing Network's members. Number 1 is Apple. Number 3 is Berkshire Hathaway.
Exactly. And that was somewhat of a surprise. So the Spider S&P 500 ETF from Boston-based State Street jumped out of nowhere into the number 2 spot this year. Wasn't even in the top 10 last year. And essentially what we heard from members and actually advisors of wealthy investors out there was a lot of people are finding that the low fees and tax efficiency of ETFs is actually making them attractive, even to investors like millionaires who have access to other alternative strategies such as hedge funds and private equity funds, which may require a minimum investment.
Fascinating, though, that their number 1 stock pick is Apple, isn't it?
Yeah, I mean, we saw a lot of news come out of Apple this week with the mini iPad and their earnings figures as well. But still, the head of Tiger One was saying to me, you know, it's one of the most remarkable companies that we've seen in our lifetime in terms of the fact that you use their products every day. About 3/4 or more of the members in Tiger 21 have iPhones, iPads, and portable Macs with them. And so it's something that they can touch and it's tangible every day, but also they've seen it rise through the ranks and do well in the market.
Your story also found, though, that overall there's a couple of trends. One is that there is less interest, it seems, in buying individual stocks, and that's why the Spider S&P 500 ETF Trust is appealing.
Right. I mean, with ETFs, you're giving up some of the opportunity to outperform the benchmark that the ETF is tracking. But what I heard from some members I talked to was that it's getting harder and harder, they find, to pick individual stocks. There's been a lot of volatility. We've seen things like Facebook that people can relate to not do as well coming out of the gate. And so ETFs are looking like an opportunity for people to build a core portfolio and then pay extra where they find it valuable for certain things like alternative strategies, but really using the ETFs as building a core equity portfolio.
You also found that index and exchange traded funds as a group are more popular vehicle than equity hedge funds and mutual funds. And when you think of millionaires, high flyers, let's get that hedge fund return, right? But not so much enthusiasm.
Yeah, it was really interesting. And I think if you look at the way the market's done this year, you know, the S&P was up year to date yesterday by about 14%. The Spider S&P 500 ETF tracking that almost exactly, up 14% this year. Then if you look at a stock like Berkshire, which was also among the list of top favorite picks, but moving down somewhat in the favorites of the Tiger 21 members, that also was returning about 14%. So I think members and millionaires even are looking at the market and saying, hey, it looks like it may be stabilizing a little bit, acting more normally. It's done really well this year, but I could go into an ETF, get that broad market exposure for low cost.
And does it seem that maybe there's less, that maybe the excitement or the lure of hedge funds, given the last 4 or 5 years where hedge funds have had to, you know, try to make the big returns in a very tough market, very tough economy, that maybe investors are saying, you know, if you're lucky and you get one of the really good ones and they strike it big, you can, but they're just maybe seeing there's more risk than they want to take, and that's why they're paring back some of their hedge fund exposure.
Yeah, absolutely. I mean, the wealthy investors that I've talked to are certainly not moving out of hedge funds or private equity funds altogether, but the ones that I've talked to even in the last 2 weeks certainly are reducing their exposure and heading towards things that are lower costs because they've realized that some of the alternative strategies that they hoped would either protect them more on the downside or outperform benchmarks aren't delivering, and in part because they cost so much in fees.
Well, that's something that I'm sure the millionaires can understand very well, that the fees can eat you up. And in all kinds of your pieces, you have stressed that point that, a bigger return with a very high fee is maybe not better than a lower return with a much lower fee, especially over time.
Right. And I think it's something that I'm finding really interesting because a lot of these alternative strategies are being pitched more mass market now in terms of changes around advertising of alternative and private placement funds. And so it's just important to understand for even the average investor that the fee can be something to look at.
Why do these wealthy investors continue to go? In a way, it's like a traditional, standard stock to invest in.
Right. And Berkshire was number 1 on the list actually in 2010. So consistently in the top 5, but has dropped to number 3. Certainly for anyone who holds a share of Berkshire, they get the opportunity to go to the annual meeting, which is a bonus to holding shares of Berkshire. I've actually covered for Bloomberg with our insurance team the annual meeting the last couple of years. And even Buffett himself was asked a question in 2011 by one of the people in the audience, what should average investors do or with their money, and what are some ways that we can get some of the exposure that you've gotten to the markets? And he actually said at that time, for someone who's not going to be watching their investments on a daily basis, index funds may be a way to go. And I think that's what's interesting about some of the data that we're seeing now, that even millionaires who have access to other things like hedge funds and private equity funds are looking at index funds and ETFs and saying, it may be a place to build up some part of my exposure to the equity markets with because of their low cost and tax efficiency.
Has this changed over the past few years? Would they in the past said, oh, who wants an index fund? It's boring. I want those, potential for big price appreciation.
Yeah, absolutely. I mean, again, you're sacrificing some of the opportunity generally with ETFs to outperform the benchmark. But I think the markets have been so volatile over the past 5 years, and it has gotten harder to pick individual stocks, as we mentioned earlier. Certainly, Buffett is one of the best ones out there, but he spends a ton of time researching the companies he buys, such as Dairy Queen or Geico, as well as the individual stocks like a Wells Fargo or Coca-Cola. Spends hours and hours and hours and days and weeks and months and months. So for a lot of investors, even those who are really wealthy, who have made their money as entrepreneurs or executives, they are finding it harder and harder and think, it may be worth it to put some of my portfolio in these index funds and ETFs.
It's interesting that most of the members of this club, Tiger 21 Investing Network, they pay $30,000 a year to be in this peer-to-peer group. They have to have at least $10 million in assets. You find out that most of them created their own wealth rather than inheriting it.
Exactly. Yeah. And it's a peer-to-peer group. So they meet monthly to share ideas on investing with each other. That's why the minimum is 10 million investable assets, not just net worth, because part of the goal of the club is to help each other share ideas and think about things to buy and invest in and how.
I'm just wondering, as you ask them about their investments, if you had a chance to say, gee, how do you feel about rescinding the Bush tax cuts? Because one of the arguments that is made on the Republican side, or from anybody like John Riding was just here from RDQ Economics, and he said that, taxes are anti-growth. Pro-growth would be to cut them and broaden the tax base. If these wealthy people with at least $10 million in assets, if you had any sense of their view of taxes, hurts, helps, does it make that much difference to them?
It's really interesting. I didn't actually ask that question to some of the members I talked to this week. I have been talking to advisors over the last couple of months as the momentum has built towards this election and towards next year when tax increases are looking like they may go up. It kind of moves around the map. I mean, certainly Buffett is one of the people who's been out there saying, we should pay higher taxes if we're millionaires. And then you certainly talk to other people who feel like they've really worked hard, especially if they've created their own business and that's where the wealth comes from, and they feel like the wealth will continue to grow if you keep taxes low, and that allows for investments. What I hear over and over, particularly from family businesses that have wealth, is that the uncertainty around where taxes will go is holding them back from doing things as a business in terms of hiring. I definitely hear that a lot from small businesses and family businesses that I talk to.
Well, that's fascinating because many reject that. Many who are on this side which says, look, everybody needs to contribute now. We've got a big budget deficit, that the taxes really don't stop a successful business in a strong economy from going ahead, hiring, making new investments in their business. So it's always fascinating to me when someone hears that from the actual business owners themselves.
Yeah, and one of the reasons I've heard this is because all of this year people have been talking about the estate and gift tax. Right now it's at an unprecedented high, so families can give up to $10 million as a couple with free of estate and gift tax because the threshold is there. And a lot of family business owners are thinking about whether or not they really should do that if it's set to expire at the end of this year. And in those conversations, they've said uncertainty around estate and gift taxes as well as income taxes is really making it hard for them to make decisions, including on hiring.
What about hard assets? Since the Federal Reserve has continued to do its quantitative easing, buying bonds, again, if you're for it, you say they need to do this. It's the only way to keep this economy afloat. The other side is critical. It risks inflation. And the next step that the critics would say is, so, by the way, if they're going to keep doing it, buy real estate.
I definitely hear a lot about real estate. I certainly hear a lot about real estate in terms of what's being invested through private equity, whether it's direct or through funds. And even with this Tiger 21 group, the actual largest part of their portfolio is held in real estate. 23% about on average of their portfolio is in real estate compared with about 22% for stocks. Very heavily invested in real estate. And that certainly, I hear from them that the fears about inflation and the advantages to having a hard asset, whether it's directly through real estate or even a REIT, is something that we're looking at.
So what's your next story? What you working on now? You usually at least have 2 or 3 in the hopper.
Yes, well, I'm actually putting on my former newspaper cap next week and helping out with hurricane coverage for our states and munis team. So we'll definitely be on the ground as Bloomberg reporters there. And then certainly we're building stories together to help people understand what they should do as the election comes and as after the election as Congress turns to the fiscal cliff, what it means for them.
Well, good. A lot to look forward to.
Thanks so much for having me. Always a pleasure.
Oh, Peggy, it's always great to have you here as well. Thank you so very much. And as I said, after the show, I'll be tweeting out her excellent story. I just think everyone's going to get a kick about reading about these millionaire investors and what they're doing.